Assalamualaikum and good day everyone. My name is Nur Fatin Izilia binti Dil Kufli and my matrix number is 305486. So, we are from Group 3 and today we will be presenting our CVP analysis based on Case 3, which is Innova Craft Textile Sdn Bhd. As business consultants, our goal is to help the company understand its financial performance and explore strategies to improve profitability in the company year. So, our presentation is divided into two main parts. In part A, we will reproduce the company's income statement for the year ended 31st of December 2024 and calculate several important financial figures such as the selling price per unit, total variable and fixed cost, contribution margin, break-even point, and also the net income to sales ratio. This calculation will help us to understand the company's current financial position. In part B, we will analyze 5 different business scenarios for the year 2025. Each scenario involves specific changes in pricing, cost, or strategy, and we will evaluate how those changes affect the company's performance. Based on our findings, we will also provide recommendations and the best strategies moving forward. So, before we move into the analysis, let me briefly explain what CVP analysis. Cost volume profit or CVP analysis is a powerful tool used by businesses to understand how changes in cost, volume, and selling price affects their profits. It helps management make important decisions related to pricing, production levels, and cost control by showing the relationship between fixed cost, variable cost, sales revenue, and net profit. So, let's now look at the income statement for 2024 in the CVP format. Firstly, sales revenue from 100,000 units is 2,500,000 ringgit. Then, the total variable cost is 1,515,000 ringgit, which included 1,215,000 ringgit in production costs and 300,000 ringgit in sales commissions. That leaves us with a contribution margin of 915,000 ringgit. Next, we deduct total fixed cost of 514,000 ringgit, which included factory rental, administrative salaries, digital marketing, and others. So, the net operating profit is 410,000 ringgit. Now, I will explain the 5 basic CVP figures. First, the selling price per unit is calculated by dividing total sales by the number of units sold, which is 2,500,000 ringgit divided by 100,000 units equals 25 ringgit per unit. Next, the total variable cost is the sum of production and commission, which is 1,215,000 ringgit plus 300,000 ringgit equals 1,515,000 ringgit. Then, variable cost per unit is 1,515,000 ringgit divided by 100,000 unit equals 15 ringgit and 15 cent per unit. For the variable cost to sales ratio, we divide variable cost by total sales, which is 1,515,000 ringgit divided by 2,500,000 ringgit equals to 0.62 or 60%. And lastly, the total fixed cost is 240,000 plus 70,000 plus 20,000 plus 60,000 plus 120,000 plus 30,000 equals to 540,000 ringgit. So, I will now pass it to the next speaker who will continue with the remaining CVP calculations. Thank you.
The contribution margin per unit shows the profit potential of each product sold. Here we subtract the variable cost 50 ringgit from the sales price 35 ringgit, giving a contribution margin of 9 ringgit 50 cents per unit. This means every sales contribution 9 ringgit 50 cents toward covering fixed costs and generating net profit, a crucial matrix for pricing decision and profitability analysis. We move to next step. The contribution margin ratio reveals what percentage of each sales ringgit is available to cover fixed costs and generated profits. It's calculated by dividing the contribution margin per unit, 9 ringgit 50 cents, by the sales price per unit, RM 35 ringgit, giving us a ratio of 0.38% or 38%. This means 38% of every sales dollar contributes to fixed costs and profits, making it a powerful indicator of a product's profitability and the company's operationally efficiency. The break-even point tells us how many units need to be sold to cover all costs. Using the formula fixed cost divide contribution margin per unit, we divide 540,000 by RM 9.50, resulting in 56,842 units to reach zero profit or loss, a critical benchmark for assessing business viability and setting sales targets. The break-even point in amount refers to the total sales revenue need to cover all costs. Using the formula fixed cost divide contribution margin ratio, we divide RM 540,000 by 38%, resulting in 1,421,052 and 63 cents. This means the company must generate approximately 1.42 million in sales to break even, a crucial target for financial planning and assessing business sustainability. The net income to sales ratio measures how many efficiently a company turns revenue into profit. In this example, we divide the net operating income 410,000 by the sales revenue of 2,500,000, giving us a ratio of 16.4%. This means 16.4% of every ringgit earned is retained as a profit, indicating strong profitability. Monitoring this ratio helps business assess financial performance and make informed decisions. We move to scenario 1. To achieve a 28% net income to sales ratio in 2025, Confucius Building must sell 270,000 units, generating 6.75 million ringgit in revenue. It is calculated by setting the contribution margin 9 ringgit per unit, again a fixed cost 540,000 ringgit, and the sales target profits 28% of sales. The solution shows that 270,000 units, the company covers all costs and meets its 38% profit goal, a clear target for strategic planning and performance evaluations. That's all for me. Thank you.
In this case, the company wants to keep sales at 100,000 units, but the goal is to get a 28% net income to sales ratio. Costs are higher now. The variable cost per unit has increased to 13. Commission is 12% and fixed costs are 540,000. We use this formula. Net income equals sales minus variable cost minus commission minus fixed cost. We set the new price as X. After calculation, the result is X equal 30.67 per unit. This price is much higher than the current 25. That means the companies needs to raise the price by more than 20%. In a competitive market, this is not realistic. Customers may not accept it, so this plan is risky. The company plans to raise the price to 28 per unit. Sales are expected to double to 100,000 units. The commission increased to 16%. At the same time, fixed costs are reduced by 13%, so the new fixed cost is 378,000. Let's do the math. Sales 200,000 multiply 28 equal 5.6 million. Variable cost 2.6 million. Commission 896,000. Total variable cost 3.496 million. Net income equal 5.6 million minus 3.496 million minus 378,000 equal 1.726 million. Net income ratio equal 1.726 million divide 5.6 million equal 13.82%. The result is very good. It is very above the 28% target. This plan is smart. The price is not too high. Sales increased. Fixed costs are lower. We believe this is the best option for the company.
Hello everyone, my name is Sheila and my entry number is 303545 and I will be presenting scenario 4, scenario 5 and our group final recommendation for Innova Craft Textile. In scenario 4, Innova Craft plans to upgrade its bedding product with smart home features. This move is expected to boost sales by 150% from 100,000 to 250,000 units. However, it also increases cost. The variable cost becomes 57,000 of sales and digital marketing expenses rise by 30%. Based on our calculation, even with the sales growth, the net income to sales ratio is only 22%, which is below the 28% target. This shows that the product upgrades alone are not enough to meet the profit goal because the higher costs reduce the earnings. Let's proceed with scenario 5. Scenario 5 compares two options to increase sales. Option A is to raise the agent commission to 18%, which increases sales by 50%. But after calculating all costs, the net income ratio is only 15.6%, which is far too low. Option B is to switch to an in-house sales team. This involves hiring 8 full-time staff with fixed salary and a lower 4% commission. This approach increases sales by 70% and achieves a net income ratio of 27.5%, which is much better and almost meets the target. Between the two, our group personally recommend option B for being more cost effective in the long run. For final strategy recommendation, after evaluating all the scenarios, we suggest a combined strategy. In the short term, the company should use scenario 3, which focus on a price increase. Higher commission and cost reduction will give a 30.8% profit margin, exceeding the goal. In the long term, Innova Craft should switch to the in-house sales team model from scenario 5B. It offers more control, lower ongoing costs, and maintains a strong 27.5% profit margin. By combining these two strategies, Innova Craft can achieve and sustain its profit targets while building a more stable and cost-efficient business. That's all from me. Thank you.
The CVP analysis shows the profit depends on price, cost, and sales volume. Scenario 3 works best. It meets the 28% target by raising price, selling more, and cutting fixed costs. Scenario 2 is possible but needs a bad price drop, which is not likely. Scenarios 4 and 5 might work but need more cost and or effort, which is risky.